The learning objectives of the section on selling a house are to understand what is a principal residence, when can you use exclusions, ownership and use tests, and the effect of family situations. Tax law has not always been so easy on home sale gains. The first exclusion of home sale gains started in 1978 when Section 121 allowed for a one-time exclusion in capital gain up to $100,000 for sellers 55 years or older at the time of the sale. In 1981, the exclusion was increased from $100,000 to $125,000. Section 1034 rollover rules were introduced in 1954 and allowed the homeowner to roll over any gain, i.e., defer payment of the gain, if they sold their primary residence and acquired another primary residence of equal or greater value within 2 years. Prior to 1997, taxpayers were required to defer the gain if they purchased a replacement home that was priced higher than the home they were selling, per Section 1034 rollover rules. Of course, this worked well if you were moving up and buying more and more expensive homes, but if you were downsizing, you could have a significant taxable gain. And as you can see from the graph, home prices have gone up and gone down. There's also a lot of detailed record keeping involved to keep track of the various purchase and sale prices of homes you owned over the years, as well as any home improvement costs added to each home's basis. And this detailed record keeping sometimes went on for decades. The Taxpayer Relief Act of 1997 amended the Section 121 exclusion and repealed the Section 1034 rollover rules. The Internal Revenue Code Section 121 $125,000 one-time gain exclusion was replaced with a $500,000 married and a $250,000 single exclusion of capital gains on the sale of a home, available once every 2 years. The property must have been owned and used as a principal residence for at least 2 of the 5 years before the sale. A taxpayer can only claim the full exclusion once every 2 years. If you do not meet these requirements because of a change in place of employment, health, or certain other unforeseen circumstances, a reduced exclusion is available. Unlike under the former 1034 rollover rules, the gain on the sale of the house is now permanently excluded rather than deferred, and a taxpayer doesn't have to purchase a replacement home to exclude the gain. A principal residence can be a single-family home, a mobile home, trailer, houseboat, or condominium apartment. An investment in a retirement community does not qualify as a principal residence unless you receive equity in the property. If you are a tenant stockholder of a cooperative housing corporation, the ownership requirement applies to the ownership of the stock. What if you have multiple homes? Your principal residence is determined on a year-to-year basis, based mainly on where you live most of the time. Other factors the IRS may consider in determining your primary residence are your place of employment, your mailing address, the address listed on tax returns, driver's license, and automobile and voter registrations, and the location of your bank. If the vacant land is owned and used as part of your principal residence, it may qualify for the exclusion. The vacant land must be adjacent to the residence. The sale of the residence must be within 2 years before or after the sale of the land. The sale of the land and the residence are treated as one sale and subject to the $250,000 or $500,000 exclusion limit. If you tear down your home and build a new home, the time you lived in the old home does not count towards the 2-year use test for the new home. For example, our old friends Jim and Judy lived in their old home for 10 years, then decided to tear down the old home and start over by building a new home. After they built their new home, they sold it after 6 months with a $700,000 gain. Since they only lived in the new house for 6 months, they do not meet the full use test. They may be entitled to a reduced maximum exclusion limit if the primary reason for the sale was, for example, a change in employment. The exclusion only applies if the dwelling sold was actually used by the taxpayer as a principal residence for the required 2 out of 5 years before the sale. In this case, the new home was only used as a principal residence for 6 months. How often can you use the exclusion? There is no limit on how many times you can exclude a home sale gain, but you can only exclude the entire allowable home sale gain once every 2 years. If a taxpayer is able to exclude the entire gain on sale from income, the transaction is not reported on the taxpayer's return. If any part of the gain is taxable, he or she reports the sale on Schedule D, Form 1040. Alternatively, a taxpayer can elect to include the gain from a sale by reporting it on his or her tax return. You might want to elect to report the gain if you have 2 sales within 2 years and the second one is the larger gain. The exclusion applies automatically to the first disposition, so you would need to make the election so that you could be taxed on the smaller gain of the second sale. If you have 2 home sales within 2 years, ordinarily you can only exclude the gain from one of those home sales. There is an exception to the rule if the second sale was due to a change in employment, health reasons, or unforeseen circumstances. In that case, a prorated amount of the exclusion limit is allowed. You must have owned and occupied a home as your principal residence for at least 2 years during the 5-year period ending on the date of sale in order to qualify for the maximum exclusion. The periods of ownership and use do not have to be continuous. You qualify if you can show that you owned and lived in the home for 24 full months or 730 days during the 5-year period ending on the date of the sale. The ownership and use tests may be met in different periods, provided both tests are met during the 5-year period. What is the effect of military and other service on the use test? You can elect to suspend the running of the 5-year ownership and use period while you or your spouse is on qualified duty as a member of specific military and other services. The allowable services are U.S. Armed Forces, Foreign Service of the U.S., Peace Corps, Commission Corps of the National Oceanic and Atmospheric Administration, Commission Corps of the Public Health Service. To elect the suspension of time, you must be on qualified official extended duty. This means you must be on active duty for over 90 days or for an indefinite period at a duty station at least 50 miles from your principal residence or in government-mandated quarters. What is the effect of an incapacitated homeowner on the use test? If a homeowner becomes physically or mentally incapable of self-care and moves to a licensed care facility, the time in the licensed care facility can be considered use of the residence time. The homeowner must own the residence while residing at the licensed care facility. This rule applies if the homeowner owned and used the residence as a principal residence for an aggregate period of at least 1 year during the 5 years preceding the sale. If you meet this use requirement, you must still meet the 2 out of 5 years ownership test to claim the exclusion. What if your home is destroyed or condemned? You can add the time you owned and lived in a previous home that was destroyed or condemned to the time spent and ownership of your current home in order to meet the ownership and use tests. This rule applies if any part of the basis of your current home sold depended on the basis of the destroyed or condemned home under the involuntary conversion rules. If a married couple owned and lived in their principal residence for at least 2 years during the 5 years ending on the date of sale, they can claim an exclusion of up to $500,000 of gain on a joint return. The specific requirements are: either spouse owned the residence for at least 2 years, and both spouses lived in the house as their principal residence for at least 2 years. Neither spouse must have claimed the exclusion within the 2-year period ending on the date of the sale. If tests 1 and 3 are met, but only one spouse meets test 2, the test that both spouses lived in the house as their principal residence for at least 2 years, then the exclusion limit on a joint return is $250,000. For example, Jim bought a house 5 years before he married Judy. After they got married, Judy moved into his house and they lived there for 3 years and then sold the house. Jim and Judy meet the 3 tests above and are eligible for the $500,000 exclusion on the gain on a joint return. What happens if your spouse dies, you inherit the house, and later sell the house? Assuming you don't remarry before the sale, you are considered to have owned and used the property for the time when your spouse owned and used it as a principal home. This rule allows you to satisfy the 2 out of 5 year ownership and use tests when your spouse met the tests, but you did not. What if the sale occurs in the year your spouse died? If you and your spouse each met the use test and at least one of you met the ownership test as of the date of your spouse's death, and you sell your home in the year he or she dies, you may use the $500,000 exclusion limit, assuming you file a joint return for the year of your spouse's death. The standard rule applies that neither of you can have claimed the exclusion for another home sale in the 2 years before your spouse died. What if the sale occurs within 2 years of your spouse's death? If you and your spouse would have qualified for the $500,000 exclusion on a sale immediately before his or her death, you may qualify for this exclusion if the sale is within 2 years of your spouse's death. You cannot have remarried at the time of the sale. To qualify for the $500,000 exclusion, you and your spouse would have needed to have met the 3 requirements for that exclusion immediately before his or her death. The 3 requirements are: either spouse owned the residence for at least 2 years, both spouses lived in the house as their principal residence for at least 2 years, and neither spouse has previously claimed the exclusion within the 2-year period ending on the date of the sale. What are the effects of divorce? If your home is transferred to you as part of the divorce proceedings, any time that your former spouse owned the residence is added to your period of ownership. What if you move out of the house as part of the divorce agreement? If you owned or jointly owned the home with your spouse and you move out of your home pursuant to a divorce agreement, you're treated as having used the home for any period that you retain an ownership interest, while the other spouse or former spouse continues to use it as a principal residence under the terms of the divorce agreement. What if spouses live in separate homes? When the spouses owned and lived in separate homes, each spouse is entitled to a separate exclusion of $250,000 on the sale of his or her home. Even if both homes are sold in the same year, 2 exclusions can be claimed of up to $250,000 each, provided each spouse met the ownership and use test for his own home. The exclusions can be claimed on either a joint return or on separate returns. Typically, no exclusion is allowed on the sale of a principal residence if you did not meet the 2-year use and ownership tests. Also, no double dipping is allowed. So if you sold another home at a gain and excluded some or all of that gain from your income within the 2-year period ending on the date of the sale, you are not allowed to exclude a second home sale gain for the same 2-year time frame. Typically, there's an exception to the rule. If the sale of a principal residence is made before meeting the 2-year ownership and use test, or within 2 years of a prior sale which used the exclusion, an exclusion is available if the primary reason for the sale was a change in place of employment, health, or unforeseen circumstances. You are allowed a percentage of the regular $250,000 or $500,000 exclusion limit. The percentage is calculated based on the number of days the 2-year ownership and use test was met. For example, if you sold it after owning and living in your home for 6 months, the calculation would be 180 days, 6 months times 30 days, divided by 730 qualifying days. 730 is the total qualifying days in 365 times 2, or 2 years. 180 divided by 730 equals 0.25, so you will be able to exclude 25% of the regular exclusion limit. This would amount to $62,500 for single filers and $125,000 for married filing jointly. If this reduced exclusion amount exceeds your gain, none of your gain is subject to tax. So the reduced exclusion amount can still be quite valuable in terms of tax savings. In fact, unless you're in a red-hot real estate market, most homes do not appreciate significantly in less than 2 years. The reason for the sale can be attributable to you or another qualified individual. Qualified individuals include your spouse, the co-owner of the residence, or any person whose main home was your principal residence. Here's an example of a sale using this exclusion exception. Before she got married, Judy owned a small house for 5 years. She sold the house and was able to exclude the gain. Then Judy and one of her girlfriends jointly purchased a condo in Chicago. Judy's friend got a job in another city, so they decided to sell the condo. Because Judy was a co-owner of the residence and her friend had a change in place of employment, this sale qualifies for a reduced maximum exclusion of any gain on the sale. The reduced maximum exclusion of any gain is available to both Judy and her girlfriend. In addition to the individuals mentioned above, the spouse, the co-owner of the residence, or any person whose main home was your principal residence, if the move is for health reasons, any member of your family is considered a qualified individual. Family members include parents or step-parents, grandparents, children, stepchildren, adopted children, grandchildren, siblings, in-laws, uncles, aunts, nephews, and nieces. For example, if Judy moved because her mother became ill and she needed to move closer to her mother so she could care for her, this would allow Judy to exclude part of the gain on the sale of her house. If the primary reason for the sale is due to a change in the employment location of either you or a qualified individual, then you are eligible for the reduced exclusion limit. Employment includes same employer, different location, a new employer, starting self-employment, or continuing self-employment in a new location. If the new place of employment is at least 50 miles further from the former home than the old place of employment was, the reduced exclusion limit is automatically allowed under safe harbor rules. This safe harbor is similar to the moving expense deductibility requirements. The change in employment must have occurred while you owned and used the home as your principal residence. If you don't meet the 50-mile safe harbor rule, you can still qualify for the reduced exclusion limit if the facts and circumstances indicate that a change in the place of employment was the primary reason for your home sale. For example, Jim got a new job as a plant supervisor at a plant that was 45 miles from his home. Although he only owned and lived in his home for 1 year, he sold his home for a $40,000 gain and bought another home 40 miles away. As a plant supervisor, Jim was on call every weekend and had to be ready to respond to emergencies by going to the plant on short notice. In this case, the facts and circumstances indicate that the change in place of employment was the primary reason for Jim's home sale. Since Jim is married, the amount of gain that could be excluded would be calculated as 12 months divided by 24 months times the $500,000 allowable gain, which equals a $250,000 prorated allowable gain. Therefore, the entire gain of $40,000 would be excluded from income. You can use the reduced exclusion limit on the sale of your principal residence if it is sold primarily to obtain or facilitate the diagnosis, treatment, or mitigation of a qualified person's disease, illness, or injury. It's also available if you move to help provide medical or personal care for a qualified individual suffering from a disease, illness, or injury. For sales related to health problems, the definition of a qualified individual includes family members, as discussed earlier. What is not a health problem? If you move to improve your general health, that would not qualify as a sale due to health problems. For example, Judy's doctor recommended that she get more exercise to improve her health. She and Jim sold their house and moved to a house on a golf course so she could play golf every day. This move would not qualify as a sale due to health problems, and Jim and Judy would not be able to take a reduced maximum gain exclusion. The IRS has provided several safe harbors for unforeseen circumstances. The following situations would automatically qualify for a reduced maximum exclusion. 1. Involuntary conversion of the home, such as condemnation or destruction of the house in a storm or a fire. 2. Damage to the home from a natural or a man-made disaster or an act of terrorism. 3. Family changes such as death, divorce, or legal separation, or multiple births resulting from the same pregnancy. Or 4. Job changes such as becoming eligible for unemployment compensation or a change in employment or self-employment status that leaves the person unable to pay housing costs and reasonable basic household expenses. Residence sales not covered by a safe harbor can qualify if the facts and circumstances indicate that the home was sold primarily because an event that could not have been reasonably anticipated before the home was purchased and occupied. Note that while worsening financial situations can qualify, improving financial circumstances do not qualify you for a reduced maximum exclusion, even if the improved financial circumstances were unexpected. So, for example, if you win the lottery, while that is unexpected, it does not qualify you for a reduced maximum exclusion. As you probably know, the difference between the amount realized and your adjusted basis is your gain or loss. If the amount realized exceeds the adjusted basis, the difference is a gain. Conversely, if the amount realized is less than your adjusted basis, the difference is a loss. Unfortunately, a loss on the sale of your main home cannot be deducted as a loss. A foreclosure or repossession of your home is considered a sale of your home, and many of the same rules apply. The selling price minus selling expenses equals amount realized. What is the selling price? The selling price is the total amount received for the sale of your home. It includes cash payment, mortgages, and the fair market value of any property or services received. Interestingly, even though the interest rates have been at historic lows, the percentage of buyers paying cash has risen during the past few years and is now somewhere in the range of 42 to 60%. The most likely cash buyers are investors and retirees. If you sell personal property with your home, these amounts are not included in the selling price. Personal property is items that are not permanently attached to the home, such as furniture, lawn equipment, or freestanding appliances. For example, Jim and Judy sold their barbecue grill with their house for an additional $100. The $100 is considered a separate sale and is not added to the selling price. Selling expenses can include commissions, advertising fees, legal fees, and loan charges paid by the seller of the home. Jim and Judy's selling expenses included a 6% commission to their real estate agent, $500 for some Facebook advertising, and a $500 payment to their attorney for reviewing their sales contract. Your adjusted basis is generally the cost of your home, plus settlement fees and closing costs, the costs of improvements, any deducted casualty losses, depreciation related to using your home for business or rental purposes, and some tax credits you may have taken related to your home. Which closing costs are added to the basis? Fees and closing costs that are for the purchase of the home can be added to your basis. You cannot add fees and costs related to getting a mortgage. Examples of fees that can be added to the basis are title and abstract fees, installation of utility services, legal fees such as for the title search and preparing the sales contract and the deed, recording fees, survey fees, transfer taxes, owner's title insurance, and any other amounts the seller owes that you agree to pay, such as recording or mortgage fees, improvements or repairs, and sales commissions. Which closing costs should not be added to the basis? Several other items are typically paid at closing, often on a prorated basis. Some of these items cannot be added to the basis or deducted as selling expenses. For example, insurance premiums, rent for occupancy of the home before closing, charges connected with getting a mortgage loan such as a credit report or an appraisal report. Any improvements with a useful life of more than 1 year can be added to the basis of your home. You can also add special assessments for local improvements and amounts spent to restore damaged property after a casualty loss. Improvements are defined as costs that add value to your home, prolong its useful life, or adapt it to new uses. When Jim and Judy owned their first home, they replaced the kitchen sink twice, added a satellite dish, and painted the exterior of the house bright green. The cost of one of those kitchen sinks and the satellite dish could be added to their basis. Painting is considered maintenance, so that cost cannot be added to the basis. Adjusted basis does not include the cost of any improvements that are no longer part of the home, so the first sink replacement is no longer part of the basis. Records should be kept of all the items that affect the adjusted basis in the house. So you should keep records such as the home's purchase price and closing costs. This information is usually contained on the settlement statement received at closing. And keep receipts for any improvements that affect the home's adjusted basis. So you can end up doing a lot of record keeping for all the years you own your home. After you sell your home, you should keep these records for at least 3 years after the due date for filing your tax return for that year. If you postpone taxable gain from the sale of your old home before May 7th, 1997, and your current home was a qualifying replacement home, your basis is reduced by any postponed taxable gain. Let's review an example. Jim and Judy bought and sold several homes before 1997. In 1992, they sold a home for $125,000 with a $40,000 gain. They then bought a home for $170,000. In 1996, they sold that home for $250,000 with an $80,000 gain. And in 1996, they bought a home for $300,000. In this example, they postponed a $40,000 gain plus an $80,000 gain, so they must reduce the basis in their current home by $120,000. Qualified use of a home is any time you use your home as your principal residence. Non-qualified use is any time the home is not used as your principal residence. Unless an exception applies, any gain now allocable to the period of non-qualified use is taxable, even if the 2-year residential use test is met. For years after 2008, if you have a home office in your principal residence, you do not have to allocate gain between the residential and business use areas of your home. As a result, your home can still qualify for the home sale exclusion even if part of the home was used for business. In other words, after 2008, a home office is not treated as non-qualified use. For years after 2008, if you move out and rent your home, the home rental can be classified as qualified use under certain circumstances. The rental must occur within the 5-year period ending on the date of the sale of the home. If you have a home office or rent your home under the prior exception, you do not have to allocate any gain between the residential and business or rental use of your home. You do have to reduce your basis by any depreciation you were entitled to deduct, even if you did not take the deduction. If you elect to claim less depreciation than was allowed and have records supporting your position, the IRS will allow claimed depreciation in the gain calculation instead of the full allowable depreciation amount. If you have a home office or rental area that is in a separate structure from your home, the rules are slightly different from when those areas are part of your home. If the business or rental use of this separate part exceeded 3 years during the 5 years before the sale, the gain allocable to the separate part is not eligible for the exclusion. The gain related to the separate areas must be reported as taxable income on Form 4797. This situation could occur if you rented out or had your home office in a separate building next to your home, such as an unattached garage apartment. A loss on the sale of your personal residence is generally not deductible, but you can deduct a loss for the business portion of the property. This loss is reported on Form 4797. If your vacation home was used entirely for personal use and you sell it at a loss, that loss is not deductible. If the sale was reported on Form 1099-S, you report the transaction on Form 8949 and Schedule D, even though the loss is not deductible. If you converted your home from personal use to rental use, you may be able to claim a loss on the sale. The amount of the loss you can claim is the difference between your basis in the rental property and the sales price. Your basis in the rental property is determined as of the date you converted the property from your residence to rental property. The initial basis is the lower of your adjusted basis in the home at the time of conversion or the fair market value at the time of conversion. After conversion to a rental property, you adjust the basis by adding any capital improvements and subtracting depreciation and casualty loss deductions claimed. If you rented part of your home for more than 3 years during the 5 years preceding the sale, you can partially deduct any loss on the sale. The deductible loss is calculated based on the percentage of the home that was rented. If your vacation home was used partly or entirely for rental or business, part of the loss is deductible. You should proportionally allocate the loss between days of personal use and days of rental or business use in the year of the sale. The personal portion of the loss is reported on Form 8949, and the rental or business part is reported on Form 4797. You generally can't start renting your home a few months before the sale in order to deduct a loss on the sale. The tax course has established 2 tests for determining if the house is a bona fide rental property. 1, you make a profit on the rental of the house, and 2, the lease prevents you from using or reoccupying the house during the lease period. Whether or not you make a profit on the rental is determined based on if the rent is greater than the sum of the following expenses: taxes, interest, insurance, repairs, depreciation, and other charges. If you acquired the house as an investment with the intention of selling it at a profit, you can generally deduct a loss if a loss occurs. This is true even if you occupy the house, provided you are only occupying the house to protect it from vandalism or keep it in good condition in order to attract buyers. If you convert your home to a rental and subsequently have a gain on the sale of the property, this sale is subject to the rules for depreciable property. If you sell a house at a loss that you received as a gift or inherited, the type of loss you can deduct depends on whether the house was ever used as a rental property. If the house was used as a rental property, you can deduct the loss as an ordinary loss. If you simply sold the house without ever renting it, you're limited to a capital loss.